In 2008, some of the most powerful banks in the world collapsed. Lehman Brothers vanished. Credit markets froze. Governments panicked. And while politicians blamed greed on Wall Street, something far bigger was hiding in plain sight. Because the system that nearly broke the global economy wasn't just the banking system. It was the banking system you never see. Today, that hidden system is even larger, roughly $200 trillion large, and most people have never heard of it. It's called the shadow banking system. And no, it's not illegal. It's not secret. It's just structurally invisible. And right now it matters more than ever. Because as interest rates shift, governments drown in debt, and liquidity tightens, the stress doesn't always show up where you expect. It shows up in the shadows. Let's start with something simple. When you deposit money in a traditional bank, that bank can lend it out. It's regulated, it has capital requirements, it has deposit insurance. It can borrow from the central bank in a crisis. It's visible, it's supervised, it has a safety net. Now imagine doing almost the same thing without being called a bank, without taking deposits, without the same safety net. That's shadow banking. Technically, it's called non-bank financial intermediation, which sounds harmless, boring even. But here's what it really means. Money market funds, hedge funds, private credit funds, investment vehicles, securitization chains, repo markets, structured finance products, institutions that move money, transform risk, create credit, just like banks do, but outside the traditional regulatory frame. And together, globally, they now rival and in some regions exceed the size of the formal banking system. In the United States alone, non-bank financial institutions hold tens of trillions in assets. Globally, estimates from financial stability bodies put the broader ecosystem near $200 trillion. That's not a side market. That's the plumbing of modern finance. So how does it actually work? Let's break it down without the jargon. At the heart of shadow banking is a simple idea. Short-term money funding long-term assets. Imagine a large investment fund that wants to buy mortgage-backed securities, corporate bonds, or private loans. Instead of using long-term funding, it borrows short-term in the repo market, sometimes overnight. Repo, short for repurchase agreement, is basically a collateralized loan. One party sells a security today and promises to buy it back tomorrow at a slightly higher price. The loan is backed by collateral. But here's the catch. If confidence drops, lenders refuse to roll over that short-term funding, and suddenly overnight borrowing isn't available, which forces asset sales, which pushes prices down, which triggers margin calls, which forces more selling. It's a modern bank run, but instead of depositors lining up outside branches, it's institutions pulling liquidity behind screens. Fast, silent, relentless. Now here's where it gets uncomfortable. Traditional banks are tightly regulated because governments learned, painfully, that credit creation can destabilize the economy. So regulators imposed capital ratios, stress tests, liquidity requirements. But finance adapts. If you squeeze risk in one corner, it migrates somewhere else. After 2008, regulations on banks tightened significantly. So a growing share of lending shifted to non-bank lenders. Private credit exploded. Hedge funds expanded into structured products. Money market funds became crucial short-term funding providers. Risk didn't disappear. It moved. Today, private credit alone has grown into a multi-trillion-dollar asset class. Companies that once borrowed from banks now borrow from private funds. These funds promise higher yields to investors, pension funds, insurance companies, wealthy individuals. Everyone is searching for yield in a world shaped by years of low interest rates, and shadow banking became the delivery mechanism. But here's the math no one advertises. Many of these structures rely on leverage, borrowing to amplify returns. Let's say a fund has $1 billion in investor capital. If it borrows another $4 billion in short-term markets, it now controls $5 billion in assets. If those assets rise by 5%, the return on the original capital looks fantastic. But if they fall by 5%, the losses hit amplified, and lenders get nervous, and funding disappears, and assets must be sold into a falling market. The system is stable until it's suddenly not. This isn't theoretical. In March 2020, at the onset of the pandemic panic, treasury markets, the safest, most liquid markets in the world, froze. Treasuries, the bedrock of global finance. Why? Because hedge funds were running leveraged basis trades, borrowing heavily in repo markets to exploit tiny price differences between treasury bonds and futures. When volatility spiked, lenders pulled back. Funds rushed to unwind positions. Even the safest assets became unstable. The Federal Reserve had to step in, not just to support banks, but to stabilize the shadow system. Trillions in emergency liquidity, not because shadow banking is illegal, but because it is systemic. Here's the irony. Shadow banking often exists to avoid the cost of regulation, but when stress hits, it leans on the public backstop anyway. Gains are private, stability is public, and yet, politically, it's much easier to talk about banks than about the sprawling network of funds, vehicles, and wholesale funding markets that sit outside everyday visibility. There's no storefront, no ATM, no customer line, just balance sheets connected by collateral chains. Now layer this onto today's environment. Global interest rates rose at the fastest pace in decades. That changes everything. Higher rates mean asset prices fall. Bonds lose value. Leveraged positions become fragile. At the same time, governments are issuing enormous amounts of debt to finance deficits. That debt needs buyers. Often, those buyers are leveraged funds operating in shadow markets, which means the stability of sovereign debt markets increasingly intersects with non-bank leverage. It's all connected, quietly. Meanwhile, private credit funds are lending to mid-sized companies at floating rates. As rates rise, borrowers' interest payments increase. Defaults tick up. But private credit doesn't trade daily like public bonds. Valuations are smoother, adjustments slower. On paper, everything looks stable until liquidity is needed. And then the question becomes, who's holding what risk? And who can sell? And at what price? Publicly, the narrative is reassuring. The banking system is well capitalized. Capital buffers are higher than before 2008. And that may be true, but the fastest growing parts of finance sit outside that perimeter. Regulators monitor them, yes, but they don't control them the same way. And in a crisis, monitoring is not the same as stopping contagion. This is the deeper mechanism. Modern finance runs on collateral, treasuries, mortgage bonds, corporate credit. These assets are reused and repledged through chains of repo and derivatives. One asset can support multiple layers of borrowing. It increases efficiency. It also increases fragility. Because if the underlying collateral loses value or becomes illiquid, the entire chain tightens at once. Think of it like a skyscraper, built on rolling short-term loans. As long as the elevator keeps moving, no one notices. But if it stalls, every floor feels it. So why don't we talk about shadow banking more often? Partly because it's complex, partly because it doesn't fit into a simple villain narrative, and partly because it works most of the time. It provides credit to companies banks won't touch. It allows pension funds to earn higher returns. It is not inherently evil. It is structurally pro-cyclical. It amplifies booms, and it amplifies stress. That's the trade-off. Long term, the question isn't whether shadow banking will disappear. It won't. The question is whether its growth outpaces our understanding of its risks. As technology accelerates trading, as private markets expand, as governments rely more on market-based financing, the boundary between bank and non-bank blurs further. And when the next liquidity shock comes, whether from geopolitics, sovereign debt stress, or something no one sees yet, the pressure won't politely announce where it's building. It will move through the path of least resistance, through collateral chains, through repo desks, through leveraged funds promising steady returns, through the shadows. $200 trillion is not a conspiracy. It's not hidden in a vault. It's embedded in pension funds, insurance portfolios, corporate financing, government bond markets. It's the part of the system that expands when optimism is high and contracts when fear sets in. And when it contracts, it does so fast. Faster than press conferences, faster than legislation, sometimes faster than central banks can react. So here's the uncomfortable thought. If the next crisis doesn't begin with a traditional bank failure, if there's no line outside a branch, if everything looks stable on the surface, would we even recognize a shadow bank run while it's happening? Or would we only see it after liquidity vanishes and the system once again asks for a rescue from the light?